Yes. So no, actually, completely opposite. We are thinking so like really looking at company growing and maturing. Right? We don't look at maturing while the business. There's a means we get credit to them, but the way we look at it is next year we're offering credit cards. So that's being built originally to the well-developed and mature businesses. Get a credit card in Mexico is probably never. Mexico. Our first go-to-market is Mexico. Completely underserved. We realized looking at no matter what we do, it's only 1 year and we'll get a business bank account. That's what we imagine we started today. I got contacted. That means asking questions like contact someone. A day later, I myself on value. 2 days later, I might come to it takes 6 months. It's not just excellent. It takes want to open up a weekly account and I read heard of Kala. Kala. She was just doing something last week and that's why it was like Western bank account. Because we use it in our US bank account. We do transfers. People want to do the word in the bank account saying Kala is not good enough. So for example, if I want to buy something to another right? I mean, imagine if that's the pain point around giving you bank account. Forget about it. No, but on the other hand, credit has it's expensive keywords, right? There's Leo, there's Quest Easter, consumer credit, there's President, there's Google, there's Steady Gusto, PayJoy, you name it, people developing Android applications to put the right things on the business. Huge market. So on the outside, like I think like what this is doing the struggle is unstructured data. But the big player and the big speak it up in the next 12 months, right? FICO score is not indication of business. Exactly what we're doing. Right? They got investments. They're right about that. Martin James, they're investing heavily in Mexico, like the US. Bigger opportunity, like more big market. Like you cannot even to say that you what are they trying to do? Trying to get back at it. Right? You love the person. My Android app. Consumer is a good segment.
Galina. Nice to meet you. Nice to meet you. Somebody sit
It's great for my family. And sometimes it's like,
we have companies rather than going to find a lot of then the way to work and work and get credit. Don't know how, right? We've been here Eventually we're going to bring it fully so far. Yeah, so I was thinking both. Privacy and GDPR.
Robert, best of luck. How's it going, Fred?
How are you? Small world, yeah.
In Chicago.
Ra về qua qua copy thì xem bên ngoài mọi người ta cái hỏi buổi.
You spent a lot of time.
I spent a lot of time. It was
Damascus, right?
yeah, and David, yeah, that's how I got to know David, who invested in FinTech. Yeah,
In Germany, and you're
yeah, it's it's in Hamburg. The biggest company is Poland, by far where they make but yeah, that one was we had
Tony,
Hey, Tony.
long time no see.
Yeah, Mark, how are you?
How are you?
Very good.
How's your day?
Last month was okay.
yeah.
Busy?
Very busy. Okay. I leave here, I fly to Las Vegas.
Lots of learning from that.
When are you coming back?
Eye-opening.
Okay. What's going on in Las Vegas?
Insurtech conference.
Okay.
I was there yesterday. Came back last night. Stayed in Sunnyvale.
You know, like the APIs.
Had a session at 1 this morning. Other stuff this afternoon. This tonight. And then go back to Vegas. So it's like the conference is going on. I just had to take a day out to be up here for other stuff. It's a little nuts, but it's good.
See you a few times
Real estate broker?
Yeah.
Now I want to ask for big call.
Yeah, those are easy, right?
We've been doing real estate loan for a while. So we see Bitcoin and other crypto assets as a new asset class. We want to lend more money to real estate as a collateral. Do you know anybody doing that kind of business? We need some borrow.
Who's your typical target for a borrower?
Usually, we just know about 3 million.
Lizzie, yeah.
Bitcoin is about $1, and he just doesn't want to sell. He has about 7 million. He just needs some big assets to do some other investments. He doesn't want to sell because of the long capital gain. His Bitcoin is collateral. So we know how to do that.
No, I totally understand. So everybody kind of delta between 485 and 9. Okay, good. Sure.
Like, you not
But you want borrowers that have crypto as collateral.
We've been doing real estate for a while. That's the market. Right.
Yeah.
We call it
Right. And are you focused on any particular geography in terms of real estate? Just
I just met Vito. I didn't realize you guys were working with. He's just come back from Nepal. So the first year time I visited,
I have
that's probably best.
there should be too much here. It's the lavalier. Do you know how to turn it on? Welcome everyone, thanks so much for coming tonight. We've got a great panel tonight, we've got some fabulous speakers and I'm sure you're going to enjoy it. Colleen Mcdonald's actually hosting tonight, but she's also on the panel. So I want to give a great round of applause to Shepherd Mullen for all their support. It's actually, we're coming up to almost 3 years that I've been running these events, twice a month at least, and really appreciate working with this company, this firm. It's a fabulous firm and great people that work here. And if you've got any questions, Colleen is sure to be able to answer them. And you can grab her card afterwards. So I'm just going to pass it over now to Mark. Mark Creager is one of our advisors at FinTech Silicon Valley, and he's been incredibly supportive and helpful as well. And he's going to let all the panelists introduce themselves. So thanks, Mark.
Great, thank you, Pamo. Just before the panel introduces, as Pamo said, I'm Mark Creager. I'm with Next Stage Partners. We work with early stage companies in the FinTech space. We've got a variety of clients on the peninsula and other parts of the Bay Area. We work with the companies themselves to kind of help them get started, and then also work with a lot of financial institutions, networks, and insurance companies to hopefully find a home for the new technology. So I've got a payments background myself. I was with Visa for 18 years, so I know a little bit about payments, although it's changing rapidly. I'm going to start with Ashish. I'm just going to ask everyone to kind of introduce it. We've got some exceptionally impressive profiles on the panel today, so kind of an honor to have you guys here. But if I could ask you to introduce yourself, give a little bit of background, and then it's just a tease before we get into the Q&A, kind of what you feel is the biggest opportunity today in credit. We'll just go down the line.
Thanks, Mark. My name is Ashish Gupta. I'm Chief Credit Officer at Prosper. Prosper, for those who don't know, we are a consumer marketplace lending platform. We provide unsecured personal loans from $2,000 to $40,000. We've been in business for 10 years, and we have done close to $15 billion in originations to date, which is under $3 billion last year. And we are launching next product this year, a digital HELOC, home equity line of credit. My background has been mostly in consumer credit. I've been in risk all along. Prior to Prosper, I spent more than a decade at Citigroup, and before that at Fair Isaac, that you may have heard of. Personally, for me, the biggest challenge in consumer credit is today we are in a very late stage in the recession, in the cycle, if you will. And at this point, the goal for me as a credit officer is to ensure that we stay disciplined, continue to innovate on the credit side, increase access to credit, but at the same time ensuring returns to investors stay in line or at least meet or beat the expectations. So that's the biggest challenge, and how to kind of get to that innovation is day-to-day things that we look into.
Hi, I'm Rohit Boris. I'm one of the partners at Propel Venture Partners. We're an early stage venture fund based here in San Francisco. We focus exclusively on FinTech, credit being just one of the areas that we tend to invest in. Prosper is one of our portfolio companies, and we've made a number of investments in other FinTech verticals as well. Prior to coming over to Propel as a founding partner at American Express Ventures, so we've been investing in FinTech for a while. With regards to credit, there are a number of areas which are equally interesting, but if I was to pick one, I think I'd like to focus on platform level tools which actually enable all the various verticals around FinTech, around explainable AI or new data ingestion platforms, etc.
Thank you. Good evening, everyone. Thank you, Fimo, and Colleen for your hospitality here. David Blumberg reporting for duty. Another day, another FinTech panel. And Blumberg Capital is headquartered in San Francisco. We have team members also in New York and Tel Aviv. So that means we mostly focus on North America and Israel for our investment space. Sometimes we've done a few things in Europe. FinTech is quite a large percentage of our portfolio, about a third of it. We have about $550 million over 4 or 5 different funds, and about 61 current portfolio companies. So about 20-something plus of those are FinTech related. We have, I'd say, focus on early stage. We like to get in before the trend happens, and sometimes we invest a little bit too early, but sometimes also those can be the best returns when they get in early and then the trend really happens. So returns I'm particularly excited about. One we generally call leveling the playing field, which is the sort of Moore's law applied to FinTech. In other words, the technology of, say, 2 buzzwords, big data and AI, plus maybe the mobile phone, offering a virtualization of many, many types of FinTech that is smarter, faster, more efficient, easier to use, etc. That's one trend. And another one they're particularly interested in is, I call it unlocking of frozen assets. There are a lot of assets that are not lendable against, ending with a preposition, but we see that there are some opportunities now to, again, use smart technologies to lend against assets that have been traditionally sort of frozen or locked up. Great.
Hi there, good evening. I'm Vilash Kubala. I'm the co-founder and CEO of Oyster. We're a neobank or digital bank for freelancers, startups, small and medium businesses in Mexico. Mexico is our first market. The way we see ourselves as a financial platform for Spanish-speaking Latin America. My background is payments and FinTech. Like Mark, I worked at Visa for about 12 years over different acquisitions. PayPal during the early days, co-founded a startup in Mexico called Clip. It's the Square of Mexico. Worked at Naspers for a little bit doing M&A and focused on EMEA. Mexico is a really interesting market, really big pain point around getting business banking. But to come back to Mark's question around credit, probably spend most of my time in the B2B, so I'll probably answer it from the context of how I see it for businesses. I think there's been a lot of focus on traditional loans, which is really to look at it as like, let's get you a loan, but I think the way that businesses are set up and the way that they have their ebbs and flows, I think it's more like a, to put it in a very technical term, I see it more like a credit operating system, right? There's not a one form of credit that's going to work for a business. We see opportunities in Mexico and other parts of Latin America where it could be from a credit card to a loan to probably a factoring, right? Depending on where a business is, there's probably the right credit product that needs to be more suggestive rather than, hey, let's give you credit and then you have a non-performing loan, right? I think that's probably more not just a Mexico thing. I think it's probably something that's applicable in a broader context. If I were to look at where credit is applicable and innovation and credit there.
Let's see if this one's on this. Hi, everyone. Good evening. I'm Colleen Mcdonald. I'm a partner at Shepard Mullen, Structured Finance and Securitization, which I've been practicing in for more than 20 plus years. My interest in the FinTech space really does revolve around that securitization and the access to capital that the marketplace lenders and start with banks and then kind of work your way out to all kinds of different entities that are offering credit in one form or another, whether it's leases or loans or something in between. Any receivables need access to the capital markets in order to free up their capital so that they can make more loans and create more product. So I think that I think it's a fascinating area. I think it's very exciting that since the credit or since the financial crisis in 2008, this innovation in credit has really come back to life. And I think by all accounts, mortgage loans probably count for a good amount of it, but basically securitization is back to where it was pre-crisis, which is kind of phenomenal when you think about where we came from in 2008 when the wheels just fell off the bus, so to speak. So I think that access to capital and figuring out the different models that are out there for that are offering credit to people and how to ensure that you're still able to fit into sort of more traditional credit capital boxes for the purpose of accessing capital is an innovation and a challenge that credit faces, and that's sort of where my interest lies.
Okay, great. So a lot of really interesting and similar comments on the board or on the panel. There's a lot of opportunity to figure out how to do business with credit utilizing non-traditional information. And I wanted maybe, Ashish, I'll come back to you a little bit relative to the thin file nature that everyone's looking at. And I heard comments around using different types of technology, using different types of collateralization, but can you give a little bit of comment in terms of where you feel that opportunity is going?
Sure. I think as you look about the credit, I think most of the lending happens today traditionally at US through bureau data. Look at the bureau, you see the information, you make decisions off it. But obviously that is not the only information, especially for people who are new to credit. That is really a disadvantage. And beyond that, I think the people who have gone through different parts of their life, they actually had to, they couldn't pay back the loan, but now have a different financial situation. So how do you get more information about those borrowers to increase access to credit? And that's where I think we look at alternate data. And data can include such as your education information. You're new to the US, you're highly educated, you have a good job, but you don't have very good established credit history. But education is a way to kind of lean into and figure out what would be earning potential in future. That's an example. Or your bank data, where you can look at the transaction history on the bank account, and then we see the cash flows coming in and out, and see your payment, your income, stability of income. So there are a lot of tools that are coming into market now, and a lot of this alternate data, whether it's education, property value, AVMs, or your bank transaction data, are really opening up opportunities for the borrowers who are being shut out of the traditional credit system, and are giving them access to credit. And that's what I think we are focusing on today, to use all this information, build tools around them, and then provide access to credit to the borrowers who can pay us back.
Great, thank you. David?
I'll just add to that to expand your very good points to other markets. For example, we are blessed in the United States and in developed countries to have credit bureaus, as you were saying, in a lot of the traditional functioning credit markets. But take yourself to the developing countries, Southeast Asia or Latin America, where there practically aren't any credit bureaus. There's this paucity of data, and yet to the rescue comes new sources of data, the explosion of big data through odd places like social media, which can give valuable signals, and other sources. So telcos have good signals. Almost everybody in the third world uses a mobile phone. So the telcos have interesting data. So you can find valuable data sources, and we have a company that just sells data to banks and non-bank lenders called Lendo, and they operate in those regions. So helping the underbanked and the unbanked, get a leg up in the rank. Then let's switch to SMBs. SMBs also face the problem of sort of thin file, analogously as an analog. And so another, again, explosion of big data through, you mentioned reverse engineering or tapping into bank account cash flows, but also e-invoicing systems, Intuit, TradeShift, Xero, FreshBooks. All these are sources that one of our companies called Fundbox uses, and there's other people that do this too, to allow small businesses to really be able to survive in a tough environment. And let's go back to 2008. The amazing data from that crisis is that when the regulators, with probably good intentions, tried to tell the banks, oh, bad boys, you shouldn't have done this kind of profligate lending, and put a lot of heavy regulatory burden, the first thing the big banks did is cut off the small borrowers, small businesses. So the day sales outstanding ratio, which is a measure of your receivables, in the United States, average small business doubled from 45 days to 90 days. Imagine what a burden that is on an average small business, a hardware store or whatever. So to the rescue come big data with AI, machine learning, because we don't need a lot of green eye-shade people underwriting these small loans. We can get pretty good signals from this flow of data that's now available. So it's a testimony to our times that we live in a time when the machinery is powerful enough, the data is ample enough that we can do things that were very costly just say 15 years ago. And so we enable us to move to a higher Pareto optimal kind of outcome for borrowers and lenders.
Great.
Yeah.
I was gonna say, relative to small business, obviously, David touched on that a little bit, but you've got a lot of need for people to grow. They need inventory. They need to pay their workers. All that. How do you manage to provide those types of services?
So I think one thing to just add on to what David started with, I think across we saw this in Europe, we see this in Latin America as well. While the bureaus are not really well established, and in fact it's bad to go to bureaus. In fact, it's negative to your underwriting to actually use a bureau.
Can you explain that? Like in Spain, until very recently, maybe it's changed. They only reported, in Spain, very developed country, they only reported negative incidents.
Yeah.
And in many places, the bureaus only take bad data. So there's no way to build a positive credit score. In ours, at least, you take both positive and negative scores, but there, a lot of them were only negative.
Yeah, so this is very true because one of our VCs in my previous startup was actually on the bureau because with the negative score for not taking his credit card once. But anyway, side story. What's really interesting to just finish out from David's story is the e-invoicing systems, and we saw this in Latin America, and it's in Europe, have actually exploded at a much faster rate because governments have actually regulated that for a lot of businesses. But there simply has been no one that has even looked at, I think one great indicator is, like what is the growth of factoring in a country as a function of e-invoicing? And I can speak specifically for Spanish-speaking Latin America, very, very low, right? Very low, and you look at the amount of credit that can be served there, and I think that's one of the areas that we always still want to get into. We're starting with a neobank and a digital bank because getting a bank account in Mexico is that hard for a business. Again, to David's point, you have large businesses that are well served, customers are well served, but the businesses in between are squeezed.
Why the low uptake on factoring in America?
Again, it's a fact that like businesses simply haven't looked at the e-invoicing data to factor. So there's one company, Factorero, in Mexico, but unlike Billy in Germany, there's no one serving the needs of factoring for freelancers, startups, and small and medium businesses, right? Even though the factura, which is the equivalent of an e-invoice, is really well set up in Mexico as an example, even in most parts of Spanish-speaking Latin America. And again, I think banks have simply not done a good job, again, in using that data around invoicing and accounts payable and accounts receivable to get into that space, which is why we're attacking the business banking side first to understand the ebbs and flows and using that data to get into the factoring space, right?
Okay.
Yeah.
David, you talked in your intro about unlocking frozen assets, and Colleen, we had a chance to talk earlier about some of the ways to look at the assets that a company has and be able to lend against that. Colleen, maybe if you want to kick off a little bit, some of the ways to take non-traditional ways of looking at assets for a business and use that to unlock operating capital.
Sure. So I was just to step back. The fundamental building blocks of how a securitization works is it's the evolution of being able to capture the payments, the cash flows, the receivables that are coming in, called financial assets, from these different loans or leases or payments, some secured, some unsecured, to capture those into an entity that is set up specifically to issue securities, obligations that are backed by the cash flow that are going to come in from those assets. So that's kind of fundamentally what securitization is. And in order to do that, in order to make that work, you have this, we call it bankruptcy remoteness. You have true sale, you move those assets, you detach them from the financial asset from the actual asset that it might be related to, be it a loan, be it a mortgage, be it a car payment. You detach it so that you can have this asset isolation. And the reason why it's important to do that is because you get better credit ratings, you get better cost of funds if you can put those assets into a special purpose entity and get the security, the assurance legally and from an accounting perspective that those assets have been isolated. So when you think about, there's been a lot of innovation in terms of moving those assets, and kind of everybody knows how that's been done for years and years. I should say there's kind of a lack of innovation these days in terms of just how do we unlock, to Mark's question, how do we unlock some of the assets from the financial assets from more traditional assets that perhaps, if you're talking about like a piece of land with a rental stream that's coming in, where you've got multiple leases generating those assets, so that it's not easy to just assign the receivables into a special purpose entity, or you have other assets that if you can't separate, if you can't transfer the asset itself, like with intellectual property, sometimes it's really tough to do a traditional securitization. The good news is that there are other ways to do it, and I think blockchain has a role in this that's still evolving, but what we do, kind of more on the brick and mortar side, the more traditional side, is that we use entities that you can divide up and use pieces of that represent an asset. So we use trusts, for instance, and limited liability companies where you can take interest in that company and say, okay, well, this interest represents this pool of underlying assets, and therefore the cash flow that are generated and associated with those assets are going to be moved into this entity. So you can do indirectly what you may not be able to do directly. And that's something that we do a lot with assets that you don't want to transfer title to, like with residential homes and things like that, where you're leasing those.
Yeah.
There's tax liability and just registration and a myriad of other things that go with it. So.
Right, David, you want to talk a little bit about unlocking frozen assets?
Yes, I have two examples, and we'll start with the housing because we have a solution to that. And I want to go back to something that you mentioned just a moment ago, Elish. I want people to take it for granted how lucky we are to live in this economy. Okay, many of you have come from some different places, and you know that the banks traditionally in developing countries lend to the government, wealthy families, and the big corporates, and everybody else, forget it. So we have a pretty well developed, small business and consumer banking thing, so we should be grateful for that. Now it's changing in the developing world very fast, very exciting. They're approaching it, head on, which is good. And again, big data and the technology helps. Now it's come to the U.S., where still we can unlock more. One example is in property. Take an average middle-class person who needs some cash liquidity from their home that they own. They have a mortgage on it. They go to the bank for a HELOC, a home equity line of credit. Can't get it because their credit score has been dinged by, like what happened to your VC who missed a payment, whatever. Their credit score is below 700. They get a no. So they're stuck. They need money to start a business, to put their kids through college, medical payment, whatever. In comes a company that we just invested in called Easy Knock, based in New York, and they do what businesses have been able to do for a long time. Sale leaseback, which is a traditional financial technique to unlock value, but we do that for the homeowner. And how does it work? You own your home, so we will come in and buy your home at market. You pay off the mortgage, you get the residual. We finance that very significantly with an onward lender. Then you become a renter in your own home. You turn from a mortgage payer to a renter. So your out-of-pocket cash flow improves because the cash generally from rent is lower than what you pay for a mortgage. Excuse me. And you stay in the home that you love. It's convenient, no moving costs. And then if you want to buy it back, you have the option to buy it back from us. Or if you want to move on and sell, you have the option, at your option, to sell the home into the market, and whatever the market will bear, we split those proceeds. You have an alignment of interest with us, and this is what helps unlock the value, because you have an option for the bottom 35% of value. We take the top 65%. So if the market is down, you're very unlikely to sell because you're going to not get very much. If the market is up and you want to move on, you'll feel great. You've taken out a mortgage, you've gotten your liquidity, and all the time you've been paying a lower interest rental rate. So that's one way of unlocking assets for a huge swath of people that are, needy but have some assets.
There's another company that I had spoken with. This has probably been about a year and a half, but they offered the opportunity for somebody that owned a home or wanted to buy a home. Let's say they wanted to buy a home, and they had 20% down. This other company would put the 80% down.
Correct. All cash offers. I mean, it's called Fly. Brad, we were just looking at my colleague Brad.
There was
the one who gives you an all cash offer. Is it Fly?
Fly Homes.
Fly Homes. Yeah.
There are multiple companies like this.
Unusual.
There's a TV doing it.
Unusual.
Fly Homes doing it. Zero Down doing it.
Exactly.
But you had the opportunity if you came in, let's say, with 20% down, and the investment company was making the other 80% for providing a return, and if you wanted to go to 30%, you could actually buy percentages of your home from the investment company. They just kind of provided a little bit of flexibility to the homeowner based on their income needs at the time or income coming in.
That's for people getting into the market and can afford the down payment. The easy knock opportunity is for people who own their home but need liquidity. So it gives you the flexibility. And the second example is a more B2B example, and it goes right to securitization. And you were talking about collateralized loan obligations from the past and all that. This Fundbox company, again, has a very interesting new offering, and I'm going to take it to the side of the lenders, the people who lend to Fundbox, so they can lend on to small businesses. What happened is that their credit of their loan book started getting really good. It's highly diversified, it's relatively high yield, it's relatively low loss ratio, and so a large lender, the name that everybody in this room knows, a huge money manager, came to them and said, wow, you offer us a new kind of commercial paper, small, diversified, small business commercial paper, which is not available in the market. You can buy Ford Motor commercial paper, you can buy GM commercial paper, US Steel, but you can't buy commercial paper of a diversified set of small business. So it's a new kind of an asset which has been created through this AI data analysis that provides a new set of options for the investor class.
Right.
Great. Let me shift gears a little bit. Ray, we talked a little bit about income share agreements. Do you want to talk a little bit about that in terms of opportunities to kind of share in the growth of a business and how that works?
Sure. So how many folks are familiar with ISAs? The ISAs, it's not a new concept. It just seems to have become more popular recently because of Lambda School. But it's a new sort of a financial instrument which has conditional obligation. And it seems like an interesting concept. The jury's still out on whether one should treat it as a debt or not, because there's no, you don't have full obligation to repay it, there are conditions that have to be met, etc.
But should define, right? Income sharing?
Income share agreement, I say, yeah. But if you do not pay off your loan, per se, it does affect your credit score. So there's still debate on whether one should consider that as a debt or not. But in situations where, as you talked about, education details being used for credit assessment, I mean, now that almost every lender or every credit officer is looking at alternative data sets, they're looking at directional indicators of future earning potential. And ISAs seem to be an approach which allows betting on the future earning potential, but at the same time limiting the downside risk for the one taking the loan. And in certain situations around, especially around education, it seems to work really well. And again, as I said, that I'm more interested in platforms that enable folks to use new asset classes or new debt instruments. So there is a rise of platforms which allow creation of ISAs and monitoring and execution of ISAs. But ISA just definitely seems to be a credible option to tackle some of the student loan crisis that seems to be emerging. There could be certain, think of it as a debt coupled with some sort of insurance product. So we are also interested in new applications around this combined instrument, where you can combine a credit product along with some level of conditional downside risk behavior.
Okay, awesome. This is a little bit of a different question, and I'm kind of open it up to the panel that wants to respond, but from a millennial perspective, there's been a little bit different aspect and view of credit. There's a lot of factors that are affecting the millennial generation coming into the market, taking longer to finish school, spending a lot more money on school than they plan to, spending a lot more money on student loans, delaying major purchases like buying a home, buying a car, because of the rideshare agreements. Any comments in terms of some of the products that you guys might be working with or familiar with to kind of address those changes in the market, and how do you think that those major purchases that are being delayed are going to impact our economy? Ashish?
Yeah, I think if you look at the recent Fed study, it clearly talks about that student loan, especially in the newer generation, have an impact on home ownership, a significant impact on home ownership there. At the same time, I think so millennials, I think if you look through the generation, they came through this environment post-recession where obviously the jobs dried up, and then eventually wages were not picking up, finally wages are picking up, so that generation has suffered a lot over the last few years. They have a very high student loan they need to repay. They have a jobs which are not paying as well, the wage families are picking up, but not picking as much. So that's probably one of the most disadvantaged generation in the US right now. And we look at our own platform from consumer lending standpoint, and that's where we do see typically the more challenged situation from credit standpoint. And therefore, and if you look at traditional data, these people are obviously not as disciplined, so they went to delinquencies and the score got down. So how do we really find a good borrowers out of them and really increase access to credit? And therefore, all the things we spoke about so far, looking into alternate data, figuring out education, figuring out the payment behavior, and asset information, how much 401k you have, for example. So you can nowadays not only look into your bank account to see the cash flows, you can also look to your investment accounts to see how much of asset you have captured. So looking at all these pieces of information to put together a kind of story of the borrower, and really use then tools, as Dave was saying, about machine learning tools and sophisticated algorithms to underwrite better. So that's the approach we have taken, but still, I mean, that generation has challenged from where we stand today.
Right. I was going to say, Balash, do you have any comment from?
Yeah. So this is an interesting segment because for us, we see a lot of freelancers. We serve freelancers in Mexico, and one of the interesting data points we saw is remote work, right? So you have highly educated, skilled people with loans from different countries that decide to move to another country, but want credit facilities in a completely different country where their highly skilled knowledge is being applied to, right? And for instance, for us, it's like, we offer small and medium business loans. A freelancer is in our segment. How do we underwrite this user that obviously has really good skills? We can't go to the credit bureau, right? Is attractive to really good businesses. They're not working for businesses in Mexico. They're working for businesses in other countries but they want the labor arbitrage of living in a low-cost country. Really good skills, right? I mean, this is a really big expat community. How do we offer them credit, right? So we're dealing with looking at highly unstructured data, right? And we're looking at how do we underwrite these users that obviously have great earning potential, right? But how do we know, and how do we go to the business that's employed or using these remote workers to actually then underwrite their possible earning potential, right? To give them credit. That's one of the really interesting things that we're seeing. Is a lot of upside, right? And also with the opportunity where remote work is going to continue to grow, right? You're not only having the ability of highly skilled workers, but highly skilled workers not in the country where they've received their education, right? And that's the opportunity that we see is really attractive for us to explore.
And it's not too dissimilar from some of the problems that expats have had over the generations.
Yeah.
You know, you come to, you know, go to the UK, or you're in the UK, you come to the US and you want to lease a car, and you have no credit history, and you can't even do something, you have tremendous income, and you can't even, you know, do some of the basic things. So that's obviously changed. Go ahead, David, I'm sorry.
Yeah, just to flip it to the other side, there's the issue of these millennials, which the original question was about, and how they feel a little bit unsteady and afraid to borrow and so on and so forth. So one of the things to help them, particularly in the mortgage market right now, is to make sure that they're a pristine payer, that they always pay their bills on time, they always pay their mortgage, and then that's good for the borrower, the lender, it's good for the borrower because your credit score starts to go up, but also help that borrower optimize and minimize their interest payments. A lot of people don't know this, but if you double down and pay twice a month your mortgage instead of once a month, you can shorten the effective term of the loan and reduce the total amount of interest you pay significantly. So there's a company called EarnUp that we've invested in that is doing that exactly, and the lenders, Freddie Mac, for example, are concerned about their lower tier, the people that are riskiest in their borrowing group who have mortgages, and they want to offer that product to them to help them become really good payers. So this is some of the tools that can be used now, because the millennials, if anything, they're very digitally native. So they're used to using technology, and that's a good way to help them maybe recuperate their lost time due to the recession, and help them with these tools that can help them become organized, efficient payers, and even reduce their interest payments over time. That's just one example.
Great.
I'll just add
Go
to
ahead,
that, if I might. I know that in addition to, well, with the student debt, right, there are lenders out there that want to try to help consolidate the debt, right, like SoFi. I think that's how they started. Certainly there's a market there, and I think that they've certainly helped to help people. There's also been a push, particularly in this residential lending home space. The rent-to-own really is designed to help people get that first down payment to get into a house. So the first time, purchasers, they can't afford the down payment. If they qualify for, for one of these programs like a Divvy, for example, then they can, not only do they get the rental of the home that they want, until they can get into a mortgage and buy, so they can exercise the option and buy the property, but they also are building up their credit profile, right? So it's designed to help discipline, to help, to give them sort of the financial, operational mechanics that they need in order to learn how to create, manage the finances, which they might not have learned along the way, and then also to get them into, home buying, home purchase. So.
Yeah, and I would say there's some great examples tonight of companies that have really, looked at the market and been able to develop a product that would be able to serve this unmet need. What I thought was interesting, and this is, going back a number of years from a Visa platform perspective, launching a number of the debit-based products, initially on the prepaid side, and you have general purpose reloadables. You can go into a Safeway and buy a Visa card off of a J-hook. That was a big deal. And it was interesting because we really wanted to extend that product out to some of the traditional banks that were very familiar with a basic DDA-linked debit card. They're familiar with a credit card, but this prepaid card was a new opportunity. And there's major banks that happen to be in the Bay Area here. And you could go to their branches and you would see a line out the door on a Friday of people waiting to cash checks that bank had issued and was responsible for cashing. And they didn't have a relationship with anybody that they were cashing the check for, right? Because they just knew it was, that particular bank. And I met with a group of their executives, and I talked to them about this product. And I said, look, you've got people coming into your bank. You could offer them this card. You could electronify their payroll. No bank really wants to give them an account. You would have the opportunity to let them use your product at your ATMs to get cash when they needed it. They didn't need to get their whole proceeds of their paycheck that day. They could use your card at point of sale, would actually generate some revenue for you, and it could create at a minimum a thin file. So if you see somebody that has a payroll card and they're getting the deposit every week or every 2 weeks, you're in a much better situation to make a decision. Maybe we do want to give those people a DDA. Maybe we do want to extend that out. So I'm just kind of curious, and I'll just throw it open to the panel. When you see you kind of the legacy banks that are trying to branch into that space a little bit, and then what I think is even more interesting are some of the challenger banks, that are coming out with a debit platform but have products that are very credit-like. Any comments, Rohit? You want to kind of
and
comment on that?
related to your earlier question on millennials as well.
Yeah.
The challenger banks, some of them have really done a fantastic job understanding their own customer segment. You talked about having visibility into cash inflow. If you look at the US, 83% of most companies do a direct ACH into your bank account for your paycheck. And companies usually submit their payroll about 2-3 days before the cash actually is transferred. And the file is sent to the banks 2-3 days in advance. So a number of the challenger banks, Varo, Chime, etc., and all of them portfolio companies, just like what they're doing, they actually provide early access to your payroll. And it's a really cool feature. Hey, you can withdraw money 2-3 days before your check actually arrives. And that's resonated strongly within their target segment. And if you look at it from a risk perspective, they aren't taking a lot of risk per se. So really is a fantastic way for them to continue to learn about the frequency at which cash is coming into the bank account, to start getting higher levels of confidence about their users' credit rating as well. It's surprising that the other larger incumbent banks have done so, and frankly, even larger banks, they're content with, if you look at some of the other approaches that challenger banks are taking, partnering with institutions to provide higher saving yields. None of the banks have responded on that either. Cash advances, I think the insufficient fund fees for Chase and BFA were like $10 billion or something. That's a very high number. Insignificant from their perspective, but still a massive opportunity for a startup to go after. And we see companies providing subscription-like services to provide overdraft protection. These are features that are resonating and are super important to the millennials and at least their target segment. And I think the incumbents have just not reacted because it's not bothering them right now.
I'm fascinated by that. So anybody?
Yeah, can I just?
Yeah.
So I think one company that, in my opinion, does really well is Neighbor in the UK. They've actually gone the opposite of the challenger bank. They want to become a challenger bank now, but they went from an employee benefit and wellness program, right? So they structured the whole company. That I think most of the fundraising is in Goldman Sachs. I love their approach, right? They said, we don't want people to get credit just for the sake of getting credit, right? They need to understand financial wellness. So just like Rhodes said, they offer you a credit product, they give you payroll advance. They've then gone into financial wellness, and then they work themselves up into getting a banking license in the UK, and then saying, now that I have you, I can give you a debit product as well, rather than kind of going the opposite way. And I think it's a really interesting scheme of the B2B to C approach into challenger banking that I think Neighbor has done really well. I like that particular model really well because I think it's very sticky because they're educating people on how to get credit, when to get credit, starting with payroll financing, right? Around payroll specifically as well, this is a big part of our go-to-market at Oyster. Really, really big pain point in Mexico because to get a business bank account is a really big pain point, but to offer payroll to your employees is a completely separate product, right? While our main focus is businesses, we enable them to offer this payroll for free. But that's one of our end journeys as well, is like, you know, the opportunity to help the end consumer as well. At some point, our initial focus. But again, you know, it's a big opportunity, I think, that in the payroll space.
Yeah. And just to camp on your big shoulders, we've seen some companies in this same genre, and another way of saying it is salary-linked lending. Because essentially you're borrowing against what you're going to be paid, and so the lender, and one of the companies we've looked at, works with all the banks. And like in Brazil, this is a big deal. It's like 50% of the consumer lending is done this way, partly because they have very high interest rates for the consumer credit, and this kind of salary-linked lending drops the borrowing rate about 75%. So it's big savings. So employers like to offer it as a benefit. But it's relatively low risk, because the way it works is that off the top of your paycheck comes the repayment to the borrower, to the lender. So they feel quite safe that you're not going to go blow it, you know, on a trip to Vegas. You're going to be paying it down right out of payroll. And so it's sort of a disciplinary tool, but it helps that consumer achieve a much lower interest rate than they would in the traditional credit card alternative. So I think those kind of things are good. Now, in the United States, we don't have very much of this, and it's faced by regulatory burdens, and maybe Colleen can talk about it, but as I understand in California, it's like, because it's a payroll, both spouses have to agree on it, because sometimes they expect, oh, if just the husband gets it, and then the wife says, oh, he's going to be blowing it on some crazy spending, you know, I want to make sure that enough is coming back to our family to pay for housing and food. So it gets complicated, but maybe the over-nanny, you know, bureaucracy, nanny state is not serving America so well right now, and Brazil's, you know, maybe smarter on that.
Yes, if I may,
Please.
yeah. So I think, as I already mentioned about the 2 days the payroll hike comes, a fundamental issue is the payroll system in the US is so outdated. In an ideal scenario, if you work for a day, you should get pay settlement on a day. You shouldn't have to wait for 2 weeks or a month to get a paycheck. That just doesn't make any sense. I mean, if someone works for you, you hire a daily worker, you have to pay every day. So fundamental issue is the payroll system is outdated. At some point, it's going to get resolved. I mean, there's a push in the Congress and Senate to kind of really update it, but obviously there's a big funding required to change the system. That's not happening anytime soon. And definitely that opens up some of these neobanks kind of really tap into space. But broadly, I think what you also see in the space is some of the companies working directly with the employers, like Walmart's of the world, and provide the financing kind of cash advance against the salary, what David was talking about. So that space is growing quite a bit. And part of the reason is alternative for those borrowers is pay the lenders, where you pay 1000% APR, which is like a predatory lending. So clearly this is a definitely better outcome for these borrowers, and therefore there is a lot of innovation still to be happened. There's some companies in the space already looking at, okay, where do you work, tapping your geolocation, make sure you go to that work every day, and then see what kind of your schedules and hours look like where you do work, and see some of the cash flow coming in historically, and then lend you against it at a much cheaper rate compared to predatory lenders, but still using a lot of this data coming from cell phones to really figure this out. That area has to still evolve from a notice standpoint, because right now those companies are under the radar and still able to go through. The moment they become big, obviously regulators will start looking into it, and to David's point, I mean, regulators have to evolve because the alternative for those borrowers is to pay 1000% APR or to get the loan at a much cheaper rate, but giving more information out about how they work and how much they earn and what their schedule looks like.
Oh, I was just going to, so just a couple of things. So I was going to say that, you know, getting an unsecured loan though is also, you know, an option, right? So in terms of like the, you know, kind of the payday lender on this side, this end of the scale, and then the innovators that are trying to get money to the employees early, you know, this payday lender label is really, it's a problem, you know, for a lot of companies. And even though I think they have the best of intentions, banks get really, really skittish about it, right? So if you've got, you know, a big bank that's doing your payroll, introducing that kind of product sends shockwaves through the system. So I think that there certainly is a place for, you know, those unsecured loans that are just not gouging. But the other thing is that the payday lending and even, well, the entire lending fabric of the United States is state by state and then federal, right? So you have this huge patchwork of regulatory oversight that is really challenging, and you have to kind of figure out where, what line you kind of want to follow down, what state is best for you, what relationships you have with other lenders perhaps that you can forge and try to navigate your way around some of this stuff, and then stay away from some of the states that are really kind of coming down hard in particular industries, because they tend to have their own industries too, like, pick one, manufactured homes, they love to pick on those things too, so.
Right. I had the opportunity to moderate a panel, some of you may have been here a couple of months ago, that really dealt with a lot of the challenger banks and some of the things that they wanted to do. And I look at a company even like Square that has really started doing a lot of things that banks do without the expensive infrastructure. First it was P2P, and then it was a point of sale system for merchants, and it was a quicker reimbursement for restaurants, which was critical. If you're running a restaurant business and you've got to pay for your groceries, you use your money from the dinners you sold on Friday night to go buy food for Saturday, Saturday morning to make dinners for Saturday night, and your processor, traditional bank relationship, isn't reimbursing you your funds until Monday. That's why you see such a challenging rate. So I think what we wanted to do tonight is really underscore a lot of the innovation that companies are taking a look at, the opportunities in there, not taking a look at the legacy systems that have kind of dragged down this industry for a long time. But I see the microphone now.
I was going to add that we've talked a lot about credit risk assessment. Just want to emphasize that that's just one of numerous things we have to look at. And customer acquisition cost being super important, collections, fraud costs, etc. And everything has to be taken into account before you form some sort of risk assessment and what rate you want to give. Outside the US, fraud rates are a lot higher, collections are a lot tougher, like in Mexico. We face a lot of interesting fraud concepts. So there are challenges to, it's easy to give money, and it's you can put a interest rate to really any sort of risk that you come up with. Recovery is critical, and the US is a lot better, but still collections are still fairly archaic even in the US. And we are super interested in new approaches towards collections. We got to look at credit risk assessment as part of the course. All our talk about AI and big data, everyone's doing it. But that by itself will not get you to pole position unless you get your acquisition costs under control.
Great. Pamela, do we have time for some questions?
Probably just a minute or so.
Okay,
Not
great.
very long.
Guys, first of all, thanks to the panel for participation tonight. I'll go ahead and open it up to questions. Yeah.
Question for David. I'm an engineer with Uber, and I would like to know if you had any learnings from the AI and big data powered decision making, where they might have created an unintended bias, and how we went ahead and how you might have seen that was resolved.
Okay. They haven't surfaced this to me at the companies that I've seen, but they're aware of it, and they're keeping check on it to make sure. Now, they're lending to small businesses, so there's less chance generally for bias than in the consumer area, especially the mortgage areas where it gets really dangerous for lenders, and we don't have any people doing that kind of lending right now. But I just mentioned, I can't fail to mention you work for Uber. Talking about regulatory state, I mean, this state to have passed that bill recently, sort of outlawing gig economy, I think it's so bad. I'll just make a personal statement. I'm not saying for anyone else. God bless you, and I hope that you win. If you sue and stop it, because
absolutely,
we've got to stop the state from telling us what to do in every minute of our lives. It's just ridiculous.
Without getting political, I would second that.
I think on that front, I think Rohit, you mentioned about explainable AI. I think that's an area which is quite getting prominence today. because part of all these machine learning models, especially in consumer lending and also in small business lending, you have to tell customer why you're getting declined. So you can't just make a decision. So even though we use machine learning models, our goal, and we have developed those capabilities to really able to explain why you're getting a score, what you got, and really then explain to consumer in a user-friendly way. So that's an area where I think is getting quite prominence nowadays.
Probably for David or maybe any other person. So I represent iBridge. We do blockchain, and my question is, this non-traditional lending or with non-traditional assets. Can you elaborate a little on blockchain, and especially like companies like MakerDAO, where they're using Ethereum as an asset to loan?
Yeah, we haven't done any investing in that area. We've looked at a lot and passed on most of them. Maybe you guys have. One thing that I would state as kind of an interesting observation, I think, is that blockchain specifically, a couple of years ago, none of the top 10 deals had any corporate VC invested in it. It was all small financial VCs. And a year later, all the top 10 blockchain that year had corporate investors in it. So we have a CIO council, the Chief Information Officer at Bloomberg Capital. We meet with in New York and San Francisco 4 times a year. And we had a topic on this, and a lot of them are starting to really do deployments now. So I think it's starting to move into an era led by the large corporations and financial institutions in particular to try and reduce the cost of the existing rails, like a SWIFT and other things like that, and try and do things in a faster, cheaper, efficient way using the non-repudiation and so on, benefits that these have. I think the issue is stability of the coin. If you're doing that, that's very important. You can't have volatility of the currency, so to speak. So if you get that one, then there's also been an issue of transaction volume per second. You came from Visa, and nothing in the blockchain area could cope with the kind of volume that they have at the B2C level. If you're talking B2B transactions between a Goldman Sachs and Morgan Stanley, that's probably more achievable on some of these things. So I'll just pause there. Maybe somebody else wants to add.
No, we haven't made any investments in that specific. We have looked at a few that are around fractional ownership of assets. And I don't think the concern was more around the technology or the approach of using blockchain. It was really more about market size, etc. But it's definitely an interesting use case, the one that we're definitely looking at.
Right, one last question.
One last question. Thank you, all panelists, for coming today. What do you think is the biggest pain point in the U.S. and globally in financial literacy for both borrowers and lenders?
Well, one aspect of it, and I don't know that it's necessarily the one pain point on both, but I think about disclosure. We talked about this earlier. In the United States in particular, it's, it's just come down from years and years and years of, it's almost habitual, but it's regulatory, that you have to have all of these disclosures, and consumers, get it in, more than anyone. And we know that they're ineffective. The CFPB knows that they're ineffective. I heard a podcast the other day to this effect with the fellow that's running the sandbox for the CFPB. So they know it's a problem, and they're trying to figure out how you get the important things to people so that they, to financial literacy, that they're hearing what they need to know, which is, if you don't pay this for 10 years at this interest rate, it's going to cost you this much more in interest. So I think disclosure and figuring out what the right disclosure is and how to get it to people now, because we don't read the we don't read what comes in the mail anymore. It has to come in our email or text or what have you. So a disclosure is what I would.
David, just real quick last comment.
I'll give 2 really quick comments. One is in the area of disclosure. Mutual funds are a big topic where people do not understand the actual fees that are being charged to them. So who knows in this company called FeeX, which clarifies all that very clearly, because the fine print of your mutual fund agreement is so hard to read for the average person. It really takes, again, a buzzword, it takes machine learning, natural language processing, et cetera, to figure it all out. So they use it now to allow RIAs, registered investment advisors, to manage held away accounts like 401ks, because if it's fully disclosed, then as a fiduciary, they can then manage those other accounts. So that's one active example. And then another one is in the average family. Children have a lot of illiteracy on financial spending. So another one called JASPE, where the parents can help manage spending for their kids through the phones and keep track of it and make sure they're not spending in the wrong place. But that's maybe a starting point too.
Great. Emma, I'll turn it back to you. Thank you so much.
Thanks so much, panelists. Really appreciate it. Thank you. So we've actually got some time now for networking till 8:30, so please get together.
No, I usually just go to West because I'm here.
Nice to meet you.